Hello and welcome to the College Investor Audio Show. We are so honored that you're here with us today as we take a look at this article from the collegeinvestor.com. House Democrats propose misguided HSA reforms. Oh boy. Quick note here, this is not like a political thing where we're going, those dadgum Democrats think that blah, blah, blah. Like, no, this is what they're proposing and this is why we think it's misguided. That's it, okay? So be nice. But if you do want to follow us on social media with some comments, hopefully it's kind, you can do that at The College Investor. Just search for those words and you'll find us pretty much anywhere you are. You can also find this article again. It's at thecollegeinvestor.com. Let's take a look. So House Democrats are moving to curb the benefits of health savings accounts, or HSAs, arguing that the popular tax-advantaged accounts increasingly double as investment vehicles for the wealthy rather than a way for families to pay medical bills. Representative Lloyd Doggett, a longtime Texas Democrat and the ranking member, by the way, on the House Ways and Means Health Subcommittee, has introduced the Health Savings Accounts HSA Consumer Protection Act. The bill arrives just as millions of Americans are facing some of the largest healthcare insurance premium increases ever. While HSAs are a great tool to invest and build wealth, their key benefit is to help families afford the high cost of healthcare in America, right? Democrats point to a new Government Accountability Office report, which you can find the PDF file inside this article if you want to read it. It's a doozy. And other analyses showing HSAs skew heavily toward higher income, healthier, and disproportionately white and Asian account holders. They also highlight projections that HSAs will reduce federal tax revenues by roughly $180 billion over the next decade. But it's important to note that healthier families opt towards HSAs because they have to. It's not by choice. These plans are typically the cheapest option in the face of all the ACA penalties. Trust me, I'm young, self-employed, have 6 kids. The ACA stuff is nuts. It's so expensive. And this potential fix would punish everyone because of the changes in qualifying expenses and reimbursement options. Not cool. So in short, this proposal is bad for everybody, except the government. All it would do is increase taxes for everybody across the board, while also providing no benefit to those who are trying to pay for the excessive healthcare costs created by the crazy healthcare system we have. It's even bad for health insurance companies and HSA providers, who will be subject to more record-keeping and potential taxes. It's actually pretty wild to see such a terrible bill proposed at all. So, what are health savings accounts anyway? Just in case you're wondering, and how do HSAs work? So, HSAs were created in 2003 to pair with high-deductible health plans, HDHPs. The idea is pretty simple. Lower premiums, higher deductibles, and also a tax-deferred account to help people cover the bigger out-of-pocket exposure. They come with 3 tax benefits. Contributions are excluded from federal income tax, and if it's actually made through payroll, from payroll tax as well. Investment growth and interest are not taxed at all. Withdrawals are tax-free if they're used for qualified medical expenses. So that combination is rare in the tax code, and it's very powerful for people who can afford to contribute to it. At the end of 2023, HSAs held about $123 billion in assets, according to the GAO. But the benefits are not evenly distributed. Doggett's office cites numbers showing that only a small share of contribution dollars come from households under $50,000 in income, which makes sense, while the bulk come from those over $100,000. Meanwhile, many lower-income families simply never get to the point of using the account as designed. Because they're healthy? A majority of HSAs hold less than $1,000, and more than 1 in 5 have no balance at all, according to the GAO. So here's what this bill to change HSAs would actually do. So the HSA Consumer Protection Act, in my humble opinion, a deceptive title, which most of these acts are very deceptive in their titles, does far more than ban hidden fees or clarify eligible expenses. In tax code language, it rewrites big pieces of Section 223. Some of those key provisions include eliminating penalty-free non-medical withdrawals after 65. Today, once account holders turn 65, they can use HSA funds for any purpose, with no tax percent penalty, though they still owe income tax on non-medical withdrawals. The bill repeals that exception, so HSAs never fully convert into retirement-style accounts. Never. Adding income limits to the tax deductibility of HSA contributions. There's a new modified adjusted gross income test that would phase down the HSA deduction once income exceeds thresholds ranging from $150,000 for separate filers and $300K for joint, reaching zero after an additional $40,000. Related changes would limit the payroll tax exclusion for contributions above those levels, capping reimbursement at 2 years. Under current rules, people can reimburse themselves many years after a qualifying expense as long as they had an HSA at the time. The bill would allow tax-free reimbursement only if done within 2 years of paying the expense, requiring real-time substantiation of distributions, too. HSA trustees would be required to confirm that withdrawals are for qualified medical expenses, and certain provider attestations would only count if there was a bona fide clinician-patient relationship and medically appropriate assessment. Narrowing what counts as medical care, too. The bill explicitly excludes spa and beauty treatments and limits HSA-eligible spending on exercise equipment to $500 a year. We don't want you to do anything that keeps you healthy. We want you to be sick so that you can drive up the healthcare costs. I don't know. I don't get it. The other thing, too, is penalizing excessive fees. A new excise tax would apply when HSA custodians charge more than a Treasury-defined reasonable amount for maintenance, transfer, paper statements, overdrafts, and other listed fees. Providers would also have to report fee and yield data to the IRS. It's important to note that you, as the consumer, would not get reimbursed for or any type of benefit from this whatsoever. It would just be a penalty on HSA providers. On paper, those changes speak the language of waste, fraud, and consumer protection. Air quotes. In practice, though, they would actually fundamentally change how millions of people use HSAs. Millions of people. This bill targets the wrong things. Supporters of Representative Lloyd Doggett's bill say HSAs function as tax shelters for the wealthy. Huh? Pointing to Treasury and GAO data, showing that households above $100K, which, by the way, is not really wealthy anymore. We have a podcast explaining all of the data in a previous episode, which you can find really easy in our archives. Anywho, Democrats say the government is losing $180 billion in tax revenue over 10 years because of HSAs, which, given there is only $123 billion in assets in HSAs as of 2023, kind of hard to fathom where $180 billion in tax revenue would even come from. The simple truth is this. This bill doesn't seem to acknowledge the current economics of healthcare in America, particularly who can even afford HSA-eligible plans because of the Affordable Care Act. The word affordable always tripped me up. Affordable to who? For who? HSA-eligible healthcare plans are just too expensive for lower-income households. HSAs are available only to people enrolled in federally defined high-deductible health plans, HDHPs. So in practice, those plans come with high premiums. In many states, including California, the cheapest HSA-eligible plan can exceed $1,300 to $1,800 a month for a family, a cost which is just unreachable for households earning less than $50,000 $100,000, or even $100,000 a year. Once a family achieves roughly $150K in income, there are no subsidies available to lower the costs. It's bad. Even families making $100K would still pay about $700 per month in out-of-pocket premiums with the subsidies, or roughly 8% of their annual income. We actually include a screenshot inside this article at thecollegeinvestor.com where you can see California's health insurance marketplace for 2026. Only 10 plans out of 38 are HSA eligible. The cheapest for a family of 4, I'm a family of 8, it's not fun for me, is $1,342.94 per month, or $16,115 for the year. And remember, because these are high deductible plans, families will pay for every doctor visit and prescription up until $7,200 of that deductible is met. Ouch. Lower income families are not opting out because HSAs are unattractive. They're just priced out before the tax benefits are even relevant to them. Even if they enroll in an HSA-eligible healthcare plan, they don't typically have extra savings they can use to make contributions to it. Surveys consistently show that nearly 60% of Americans cannot cover a $1,000 emergency. They're not going to put money in an HSA if they can't even afford the basic stuff. Deductibles continue to rise faster than household savings. This is just reality. Federal HDHP rules require sizable deductibles and out-of-pocket maximums. 2025 requirements, deductibles $1,650 or $3,300 for the family. The out-of-pocket maximums, $8,300 for yourself or $16,600 for a family. That's out-of-pocket maximum. Oh! 2026 requirements? It all went up. $1,700 for self-deductible, $3,400 deductible for families. Out-of-pocket maximum, $8,500 for yourself and $17,000 for your family. These limits apply only to in-network care. Out-of-network spending is substantially higher. And HSA contribution limits have not kept pace. In 2025, a family can contribute $8,550, and in 2026, up to $8,750. Doesn't cover out-of-pocket. It would take families at least 2 years to save to be able to afford something catastrophic, or even a planned childbirth. If there's a 2-year reimbursement window, families might not even have enough money to cover the mandated out-of-pocket expenses. So, let's put this into context for a second. If you contributed the maximum individual contribution from the HSA inception through 2025, the max you'd have contributed to this account over 22 years is $72,600. If you're a family and did the same thing, the total contribution over 22 years would be $145,050. We're not talking large sums of money, really, especially if this is targeting the wealthy. Income limits introduce a benefit cliff. This is the biggest problem, in my opinion. Doggett's bill phases out the HSA deduction starting at modified AGI of $150K for single filers and $300K for joint. It's important to note that households at those income levels already receive no affordable, again, air quotes, CARE Act premium assistance, pay some of the highest premiums in the entire market, and often struggle to save anything beyond the basics. It's why making $100,000 in America still leaves you broke. We have an article, a podcast devoted to that. You can go back and listen and read as well. Plus, HSA contribution limits are a prime example of a marriage penalty, which is just wrong. You can see that it's mathematically better to be 2 single people contributing to HSAs than a family. This is crazy. For a lot of people, the HSA deduction is the only remaining tool for taxes that individuals and families have to help with all the rising health costs. That's not giving money straight to health insurance companies. So what is actually helpful in this bill? I know we've said a lot of bad stuff. I don't know. There's one semi-positive proposal. preventing excessive HSA fees and opaque account disclosures. All right. The legislation would require custodians to report detailed information on maintenance charges, transfer fees, paper statement fees, and other common add-ons, costs that often erode the small balances held by lower and middle-income users. Cool. Let's cut everything else in the bill and just have one page, front and back, explaining this. And we're good. It'll pass. It's important to note, though, that our list highlights these fees, and the best HSA accounts don't really have these things anyway. So we don't even need this bill at all. It would also impose an excise tax on fees deemed unreasonable, giving the Treasury authority to penalize custodians who charge far above market norms. Again, the best plans don't do this anyway. But the bill actually stops short of defining a clear, excessive fee cap, leaving reasonable fees to be determined later through more regulation. Again, though, while this bill does make a pseudo attempt at some type of consumer protection to solve an actual problem, it doesn't even do that. It could have been just as easy to write a bill that says HSA plans cannot charge monthly maintenance fees nor require customers to maintain minimum balances. But can anybody in Congress really do anything that simple? It should make you frustrated reading this and listening to this that our legislators can't do simple things. They can't. They have no ability to do it. What this would mean for consumers if passed. Okay, so if the bill does, for some reason, get the votes to pass in its current form, here's the impact. Retirees and near retirees would lose the ability to treat HSAs as a quasi-retirement account after 65, limiting how they can tap those balances for broader financial needs. Not good. Planners who stockpile receipts to let funds grow tax-free would see that strategy disappear with the 2-year reimbursement window. People near the new income thresholds could find themselves suddenly unable to use the HSA, even in the face of healthcare expenses. Everyone with an HSA debit card could face new friction as trustees start policing receipts in real time. Low balance account holders might finally get some relief from maintenance and junk fees, one of the few parts of the bill that even critics see as overdue. For now, though, the proposal is not likely to go anywhere, as it shouldn't, but it should be a big red flag about what Democrats are thinking about this kind of thing. Instead of fixing healthcare premiums, they want to punish consumers who save and invest to plan for the future. Huh? Consumers who rely on HSAs for tax savings or even future medical costs might want to watch this debate closely. In the meantime, though, make sure they understand their current plan's fees and record-keeping rules in case Congress decides to change them. If you know anybody who could use this podcast or article, please share this with them. If you know somebody who's using an HSA account, because this is an important debate we gotta stay on top of. And we will do that. You can follow us, like us all over social media, ask questions, whatever you want to do. We'd love to get to know you better so we can help you along in whatever journey you're on in money. You just look for us, The College Investor, and you'll find us. Check us out at thecollegeinvestor.com as well. Thanks so much for stopping by today, and we'll talk to you again real soon.